right, let's hear some of these Wall Streeter big names and their opinion for 2025.
Especially after what happened last week on Friday. Tom Lee's here, Fundstrat Global Advisors, Chief Investment Officer and a CNBC contributor. This is not this is a Grinch rally or the Grinch sell-off. This is not a Santa Claus rally. It's not going as planned, Tom.
It's not. I think investors have been a bit nervous.
This is so silly. We already had the Santa Claus rally. The Santa Claus rally already happened. Was anybody in the market in November and December? Like, oh my gosh, the market was full risk on. Are you kidding me? So Santa Claus came to town. Let's just be very, very clear about that. Santa Claus came to town. We just got our presents a little early. That's all that happened there, right? And then at the end of the year, you got some tax loss harvesting situations, right? And that's all normal stuff. But let's be very crystal clear. Santa came to town, and Santa brought a whole bag of presents, and I mean a lot of presents. Yeah, if you missed November and December in the market, whew, you missed 5, 6, 7 figures of profits.
This December 18th,
Crazy.
the FOMC rate decision, and worried that the Fed may not be as dovish as investors previously thought. But I think fundamentals have remained intact. So to us, I think this is a bit disappointing, but it's, I think, a bit of profit taking, some hesitancy around the Fed. But I think it doesn't really change that 2025 is shaping up to have a lot of tailwinds.
So this just delays some of the continuation in a secular bull market that you've been talking about?
That's right. I mean, I think one of the lessons of 2024 has been we've seen periods of market wobbling and weakness. We know investors get pretty quick to turn bearish when that happens, but it turns out that these have all proven to be buying opportunities. I don't think there's a lot of signal to me that December's been a weak month.
Let's be really crystal clear about this, folks. Let me be very crystal clear about this. Every time the stock market goes down, it's a buying opportunity. Every single time. Not one time in the last 100+ years has S&P 500 ever gone down and it wasn't a huge buying opportunity. Not one time. So, sometimes people got to get out of this framework of thinking so short term about what's the market going to be tomorrow or the next day or the next week or the next month or even the next year. And sometimes you got to realize, every time the S&P 500 goes down, it's a buying opportunity, okay? The bigger it goes down, the bigger the buying opportunity. That's as simple as that.
Obviously disappointing because it should be a seasonally strong period, but, if we, end down even, S&P 5,900 into year end, I don't think it just changes that in 2025. There's a lot to look forward to.
There's going to be some time period in the future where they're debating if the S&P 500 is going to go down to 50,000 or go up to 55,000. There's going to be some time period where they're trying to figure out, is the S&P 500 going to go to 100,000 this year, or is it going to go back down to 85,000? You got to understand that.
So what you thought might happen this year being...
If we go back 30, 40 years ago, they were debating if the S&P 500 was going to go to 500 or go to 1,000 or not, right? And now we're debating if it's going to 6,000 or 7,000. Keep that in mind.
So what does that mean for next year? Let's say the first half of next year. What do you think we're in for? And, with valuations and where multiples are right now, with all that in mind, do you think it could be a really positive first half of the year?
I do think that one of the things that we're watching most closely is what happens to CEO confidence early next year. We know they've been cautious for the last 2.5 years. It's really evident in looking at measures like the ISM manufacturing that's been below 50 since October 2022. And that's highly correlated with S&P earnings growth. I do think that that's going to finally recover to above 50, kind of signaling that we're back into an expansionary CEO mindset. It is purchasing managers. On top of that, we have an incoming administration that ultimately is going to be viewed by markets as pro-business, and I think that reignites animal spirits. And I think the Fed is going to prove to be dovish. Even if they're trying to figure out where neutral is, they're still supportive of markets. It's a good combination for I think, upside for equity. So, in the first half of next year, I think S&P can get close to 7,000, and that's a lot of upside from here.
Yeah, what's crazy is a lot of people, they stayed out of the market last 2 years, and just what a mistake. Like, you weren't in the market in 23, 24, what a mistake. But this goes back to a lot of people think they can try to time the market and get in and get out and like, oh, I'm going to buy stocks when my guy's in office. And I'm like, okay, have fun not making money. Like it's incredible. Like, people just don't understand math. They don't understand math. They don't understand how the market works. And it can be a very simple game, but it can become a very stressful, complicated game if you want to play these games of like, I'm only going to invest under this type of president, or when the CEOs are feeling good and their confidence is high, right? Like, you could play that game, but I mean, you just missed out on ridiculous gains. You missed out on a 24% return for the S&P 500 in 23, a 23% return in 2024. Like, you missed out on so much money, and that's on an index level. Never mind with individual stocks that have gone up 2x, 5x, 10x, 20x over the past few years. I'm like, where are people at, man? Just so much money to be made, tens of thousands, hundreds of thousands, millions of dollars to be made over the last couple of years, and people just weren't there to make the money. I mean, the good news is, if you're getting in the market now, like, you got a lot of money to be made over the next 10, 20, 30 years, but you did miss a lot of money over the last 2 years, right? But then those same people could look at it and say, you know what, I'll wait to buy till the next crash or something. Well, yeah, maybe that could be next year or the year after, or maybe you're waiting 3 years, 4 years, 5 years. And by the time the crash happens, it's crashing to a level that's still significantly higher than where the market is today. That's something you got to keep in mind there, right? So, yeah.
A CNBC contributor, of course. Tom, good to see you.
And no one ever buys at the absolute bottom. That's not how it works. You buy over a period of time. So the whole thought, like, I'm going to buy right at the bottom, this massive crash. Nope, that's not happening either.
Here.
Happy New Year to you.
So first off, Tom, what's your diagnosis of what the market's been contending with here in the last several weeks as we've gone sideways and had sort of this negative skew toward market breadth?
Markets kind of did flail into the end of last year and the first day of 2025. And I think it was trying to digest a few things, that the pretty dramatic move in long-term yields and the dramatic drop in yields in China. I think that there has been some concerns about macro as you saw some events over the past few days. And I think there was general profit taking and some sort of like, let's wait and see how 2025 is, given we just booked 20% back-to-back years.
And do you think that those things will remain overhangs? I mean, obviously, you certainly have a bullish orientation. You feel as if the S&P 500 can get to 7,000 by mid-year before perhaps a pullback. Well, if we're getting from here to 7,000 in less than 6 months, you're talking about, 35% annualized pace of gain. So how do we get there?
Well, I think one thing the viewers need to keep in mind is that just because the calendar year changed doesn't mean that the strength that we saw throughout 2024 suddenly has evaporated. There are tailwinds building because the Fed is dovish, even if they're making fewer cuts. But I think one of the sort of two important things happening early in 2025 is going to be, one, we're seeing manufacturing recover. The ISM manufacturing, posted one of the highest readings in almost 2.5 years. I mean, it's been below 50 basically for nearly 3 years. And the second is that I think the labor market could be soft.
Ask me, will I take it if the S&P 500 goes to 6,600? That's fine with me. Perfectly fine with me. But also 5,600 is fine as well. 4,600 is fine as well. 7,600 is also fine. Whatever.
In a way, because whether you look at link-up data or the ISM employment, to tell us that the Fed now has to be focused back on supporting the economy. So I think this month could be quite decisive in the sense that we've got weakness because of some insecurities building, but I think it's, the same tailwinds are in place. I mean, I think it's still a buy the dip kind of market.
And in terms of perhaps the same themes being in place,
it's always a buy the dip market. Always a buy the dip market.
Does that mean that
if you're
the leadership
investor,
profile of the market you expect to stay similar to 2024? I mean, I know it's waxed and waned between mega cap growth leadership and then some broader participation, but we did finish again with dominance by the NASDAQ 100 type stocks.
Investors still are going to pay for earnings visibility, and that's why I think the Mag 7, including NVIDIA, are going to be important holdings. But financial conditions should ease this year. Easing financial conditions does allow some cyclicals to post better earnings growth, like financials and regional banks, industrials, and small caps. So I think that there should be a case for broadening of the markets this year. And then finally, I think in terms of risk appetite, still one of the good measures to look at how risk appetite is to look at something like Bitcoin, and at 97,000, it's still telling us that, this is still a risk on market.
Yeah, I mean, obviously it's held almost all of its gains since that little poke above 100,000 in Bitcoin. Although I do wonder what you make of the relatively heavy outflow we were seeing in the BlackRock ETF that holds Bitcoin, whether it was just sort of deferred profit taking into a new tax year or something else.
It's hard to tell. And I think with the ETFs, it is creating, I think, an interesting dynamic, which is that someone who sells a BlackRock ETF doesn't have a 30-day holding period if they buy another Bitcoin ETF. So I think in some ways you can see people doing basis swaps and stepped up in tax optimization strategies and not really having to worry about that 30-day holding period.
It's funny, in regards to Bitcoin, and I've been trying to tell people this. No one listens to me in regards to this subject, but they should. Bitcoin is going to be so, a lot of people are like, oh, it's so great, this Wall Street money's coming in Bitcoin, woo, and I'm like, there's bad stuff that comes with that as well, which is huge manipulation. Like, people have no clue. Like, they think like it's just, as with all things, they think it's only good that comes with it. And I'm like, get ready, because now that Wall Street's got their hands on it, now that the big money, they talk about Bitcoin whales. Bitcoin whales aren't big money. BlackRock's big money. Wall Street's big money. The big players, the hedge funds, they get their hands on Bitcoin, get ready for manipulation, crazy manipulation, right? In terms of price swings and like capped gains over a certain amount of times and a lot more short term. Like, I think the best time ever for Bitcoin was before the Wall Street days that are now upon us, right? And so anyways, we'll see how all that shakes out, but get ready.
Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area.
Winning Resorts. A stock that's done a whole lot of nothing over the past year is down about 2%, right? Wynn Resorts has the premier properties in Vegas, Wynn and Encore. They're the premier properties in Old Macau. They have the premier property in Boston area, which is right outside Boston, right, in the Encore property. Additionally, they have the Cotai Strip property, which is, I think, the crown jewel of the Cotai Strip. And they're building a property right now in the Middle East, which is, a very untapped opportunity. Let's just call it that. Untapped. Oil money? Okay, maybe we're putting some things together there, okay? Very diverse, high-end business. A lot of the top 10% of income earners, top 10% of the wealthy like to go to those sorts of properties if you're going to Macau, if you're going to Vegas, if you're going to Boston, and then when this Middle East property opens up, right? Now, the stock price performance for this company has really been out of their hands over the past 5 years, right? And it's kind of unfortunate. But here's the thing. If you're a Wynn Resorts and you run those high-end gaming resorts and the government says we're closing down the economy, you don't have any choice. And that's the thing that sucks for Wynn. Like, Macau was partially closed for 3 years. For 3 years, right? Vegas completely closed down, my city, right, for at least a few months there, and then we slowly ramped back up, and that took about a year and a half to ramp that business back up. So that was completely out of their hands. And you know what else was completely out of their hands? The Fed going through the fastest hike cycle in history, right? And taking Fed funds rate up to the highest levels we've seen in many decades. And so those were when that happens, essentially, no one wants to own any debt-laden companies, which if you run a resort company, you're going to have large numbers of debt. You're going to have billions of dollars of debt, right? And no one wants to own those sorts of stocks when the Fed goes wild like that in terms of just raising interest rates. And so it had two very existential issues that happened to its stock price that were completely out of its hands. It's like they couldn't control if the Fed was going to raise rates, like they did. They couldn't control the government was going to shut down the worldwide economy, but they did. And so really this company's stock price has not been in their hands the past 5 years, but I do believe that's going to be very different over the next 5 years. I do not believe we're about to go through any sort of major hike cycle for the Fed, and I do not believe we're going to go through another once in a 100-year health event, right? That's why they call it a once in a 100-year health event. No. In regards to Wynn Resorts here, right, you look at it on a trailing 12-month basis in terms of the revenues of this company. I mean, they've climbed substantially. Now, analysts have gotten, I would say, pretty bearish overall, where they don't have much revenue growth going for Wynn at all, right? And we'll see if that comes true. They might be a little too conservative in regards to 25, 26 for this company, right? Now, additionally, you look at trailing 12-month free cash flow for Wynn Resorts. Whew. I mean, what a change, right? And this was basically government-forced shutdowns and all that stuff, right? And obviously they were losing a fortune, and man, have they changed the free cash flow story in regards to this company in a major way. Additionally, just as important, look at the operating income for Wynn Resorts, right? Once again, you don't have to be a stock market genius to look at that chart and be like, dang, that's pretty darn impressive what they've done with operating income there, right? Now, another way I like to think about Wynn is not just like all the money they're bringing in, right? What's going on with their revenues and their EBITDA, right? Because do remember, EBITDA is very important for a company like Wynn Resorts. And the reason being is a company like this takes massive depreciation and amortization every year. Like we're talking many hundreds of millions of dollars every year, which makes them look not as profitable as they really are, okay? So that's why EBITDA is very important for these sorts of resort names, right? Now, enterprise value is very important to look at for companies like this. It's a key number. And you look at that, and the reason enterprise value is it takes its market cap, and then it also looks at cash and investments versus debts, okay? So you get a real better understanding, at least in my personal opinion, of what you're actually paying for the company. So enterprise value is $20 billion for this company. But here's the thing. I don't believe you could build all of Wynn's properties for $20 billion. I don't think it's happening. And so that gives me a lot of comfort in thinking like, let's say you could have the culture in the employee force and the design and everything Wynn has, right? And the unbelievable customer base they have. But what if you just try to replicate the properties? I don't think you could do it for $20 billion. Not with how expensive construction is nowadays. There's no way you're building all their properties, in my opinion, for $20 billion. So that gives me some comfort, right? Additionally, dividend payer, obviously, with this one, and I think the company's going to be paying much bigger dividends over this next 5 years. Like, I think, especially if they don't do the New York property, which I have a lower and lower belief that they're going to do the New York property, the dividends are going to be substantial here. And as far as the land in Vegas, I don't see them building anything on that land yet either. And the reason being is the north end of the strip has two problem properties already having an issue. Fontainebleau is having a lot of issues from what I'm hearing on the ground. Resorts World's having a lot of issues from what I'm hearing on the ground. And so there's already two troubled properties that are pretty new on the north end of the strip. Additionally, they're building more properties next to Fontainebleau right now. So my hunch is Wynn's probably not doing anything with that Vegas land across from them anytime soon, unless they were willing to sell it to somebody that would be willing to pay a big number for that. But and so that makes them kind of in a situation where they got this Middle East property they're going to be building out, but I don't see it being very likely they build out some big property here soon because, like I said, New York's always a mess, right? And so like New York does some things very well, but they do other things very poorly. And it's just I have a hard time believing that Wynn's going to bend over backwards for New York. I think it's going to be too much fighting. And it's not going to end up working out because Wynn's going to want certain things their way because Wynn usually gets their way, right? Meanwhile, you have New York City that is used to getting things their way. So I think it's it would be an incredible opportunity, but I see it not being very practical. So then the question is, what is Wynn's going to do with all this money?
What's it going to do with all the money? So then you get into a situation where they could pay down debts if they want, or they could continue to up that dividend over the next few years. And that's my belief, is they're going to up that dividend. And then when the Middle East property opens and the cash flow start pouring in for that, they can raise that dividend a lot. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area. Elf Beauty, ELF on this one, cosmetics company, and their company is growing into a cosmetics giant. Now, what do you see in that stock price there? I'll give you a second. Tell me what you see. You see a stock that obviously got heavily damaged. The stock went from $200 down to $100. It got cut in half in 2024 at one point, right? I believe there's a lot of growth worries around Elf that are not substantiated, right? And so the 1 year on the stock, it's down, we can call it close to 10%. Meanwhile, you look at the company's business model, and it's an animal, man, an absolute animal. Look at the trailing 12-month revenue of Elf. Boop, 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 and crazy. And here we are, a lot of analysts are kind of thinking growth is going to somewhat stagnate over this next year, right? I just don't see that happening. I don't see that being very realistic. Based upon the numbers, based upon the management's commentary, it doesn't sound like it, okay? Now, look at the earnings per share. This is where we are at right now, okay? What's going to transpire for ELF in 2025 and over the next 5 years, if we can call it 2025 all the way to 2030, is we're going to see, in my opinion, a massive earnings per share growth cycle that's going to start in this company. Think about it this way. The last 5 years for ELF were all about revenue. We're all about market share. Revenue, market share. More stores, more doors, right? The next 5 years, ELF's grown into a more mature company. It's about margins. It's about earnings per share. It's about the money. It's about the profitability, okay? Now, they've captured this massive market share, right? Well, massive is a relative term, right? It's massive market share compared to what they used to have 5 years ago. But now that they've done that work, now they can worry about profits more so, right? Because that really hasn't been much of a focus for the company over time, right? Now, shareholder equity is the best it's ever been for this company, right? So balance sheet's looking stronger and stronger and stronger, which puts them into a better and better position to acquire other companies if they want to do so, share buybacks if they want to do so. Eventually, they'll probably start paying out a dividend. Probably not in the short term because the growth is too strong still in this company, but I wouldn't be surprised if a few years from now they start paying a dividend for this one, right? Now, here's some projections I have for ELF, right? So the net income growth is going to be pretty substantial in 2025. So, we could probably put net income close to $200 million in 2025, right? On revenue about $1.5 billion. After that, I have them doing 20% revenue growth per year. And then I have them doing 30% net income growth per year after that, right? Which puts them at net income margins of 16% come 2028. I think long term, they're going to get to 20% plus, by the way. Now, PE 35 to 50 is pretty fair for this company. I mean, at the end of the day, cosmetics, beauty company, almost like a SaaS type business model in terms of like people run out of something, they go buy another one, right? So you should always command higher multiples on these sorts of stocks, especially when you've got, very nice double-digit growth that I'm expecting for ELF, which puts the stock in 2028 somewhere between, let's call it $250 and maybe even potentially up to $350 plus, right? So at 131 buying it today, it's a pretty attractive risk reward. And when you think about the risk side of ELF, is there a lot of risk in ELF? Not really. The stock's come down so much, it de-risked a lot, right? And unless, I don't know, everybody just decides to stop buying ELF products, like they're looking pretty darn good in regards to this one. No, there's a position I have in the public account. I've done tremendous on it, up 1,700%. But I just bought shares, not in the public account, but I bought shares in another portfolio. And that might be a hard thing to do psychologically because, up so much on the stock. But at the end of the day, here's the way I think about it. That's irrelevant. Like, all that matters is what my likely returns are, the risk reward profile of that stock over the next 3, 5, 7 years, right? So it's unbelievable to see that gain. But at the end of the day, the stock is still actually a buy here in the low hundreds, okay?